Hi, we are living in extraordinary time. There is a carnage going on in the equity markets globally. In last 30 days, bearing Chinese markets, most of the global equity markets have fallen between 10 to 30%. The fall across the world is as sharp as 2008. This time, though, the market carnage is driven by the fear of coronavirus. Since there is no known medical cure available for coronavirus, countries are responding by locking down cities and shutting down activities. This lockdown, which is absolutely necessary to contain the spread of coronavirus, is creating a huge economic cost on the impacted economies and resulting into market meltdown. Market today is ignoring few consolations, such as more number of people have been cured from coronavirus than who have died. The fatality rate of coronavirus is far lower than many other diseases. Median age of Italians who have died is about 81 years. That is, coronavirus is impacting old people far more. Maybe partially the social media spread too much awareness about coronavirus compared to other such diseases. There are companies which are trying various permutations and combinations to find the medical cure for coronavirus. Companies from countries such as Israel, Korea, Canada, UK, China are working to find a medical cure for coronavirus. This is a complex subject and we don't know where the truth is. However, based on past experience, we draw a conclusion that just like we have found medical cure for Ebola, Zika, SARS and other kind of viruses, at some point of time there will be a solution for coronavirus. Our hope and prayer is that it should happen sooner rather than later. Our markets have fallen in line with global markets, wiping out investor return across market cap. Global as well as our equity markets will start stabilizing once they get the comfort that coronavirus is curable and there is vaccine available to contain spread of coronavirus. Since most of people are aware about the carnage and its negative effect, let me talk about some positives which are not discounted by the market right now. In October 2008, at the peak of subprime crisis, our market cap bottomed at $510 billion. At that point of time, market cap to GDP ratio was about 43% and it stayed just for a day there at that bottom. Currently, our market cap is about $1.68 trillion. The market cap to GDP ratio is about 56%. Clearly, from market cap to GDP ratio, we are becoming cheaper. Oil prices have come down from $68 per barrel to $35 per barrel. Every drop of $1 in oil price benefits India by about 1.4 billion. If oil prices persist at current level, benefits to Indian consumer, Indian corporates, Indian government will be somewhere to the tune of $46 billion. Our trade deficit with China officially is about $58 billion. But if we include hawalas and routing from other countries, that number could go up to as high as $70 billion. We could easily save $10 to $12 billion from Chinese deficit, as Chinese exports will be impacted due to coronavirus scare. This will encourage local manufacturing. Central banks around the world are cutting interest rates and pumping liquidity. In 2 installments, US Fed cut rates by 100% or 150 basis point on a base of 1.58%. Bank of England cut rates by 66% or 50 basis point on a base of 0.75%. There is expectation in the equity market that the RBI will also lower interest rates to support growth. There is likelihood of shift of manufacturing from China to other countries as the firms start diversifying their supply chain post-coronavirus episode. India has great opportunity to welcome those companies and become part of global supply chain. This can support India's growth for years to come. Samsung, which came to India before it went to Vietnam, today contributes 28% of Vietnam's GDP. The turnover in Vietnam is $62 billion. We need to attract such large companies to India. If we can become part of global supply chain, then our growth will be taken care for years to come. Currently, markets are rightfully looking at the negative scenario on fears of trade disruptions due to lockdowns. Unless a medical solution emerges, there is less likelihood of markets to settle down. Lower oil prices, lower interest rates, higher liquidity, and lower trade deficit with China will not be discounted by the markets till such time there is a medical solution for coronavirus. Our fundamentals till now have not deteriorated as much as China, Italy, or Iran. Today, markets are pricing that India will not be able to contain coronavirus scare. Rightly or wrongly, this perception is pushing foreign portfolio investors to sell their India holdings. The persistent and intense selling by FPIs is resulting into sharp drop in prices. Hopefully, we will be able to change that perception by containing coronavirus like we contained Nipah virus some time back. As investor, our recommendation has always been same: be a long-term investor, be a regular investor, and be a disciplined investor through a asset allocation. We don't know where the bottom of the market is, but we do know that every time there was a correction in market driven by Zika, Ebola, bird flu, SARS, over a period of time market bottomed out, and from those bottoms market did deliver fantastic return to the investors. As coronavirus scare gets contained through medical solution, markets will make a bottom and will reward investors who take risk during this period. One complaint which we receive from investors, that you talk about disciplined asset allocation, but you don't have product which does asset allocation for us. 1.5 years back, we launched Balance Advantage Fund, which does this disciplined asset allocation for investors. This is a fund where we divide our exposure in pure equity between 20 to 80% of the fund size, looking at the valuation of the market. When markets are very cheap on valuation, our equity allocation will go to 80%. When markets are very expensive, our equity allocation will fall to 20%. By dynamically managing equity allocation, we try to contain volatility and enhance return for the investors. Over last 18 months, Kotak Balance Advantage Fund has delivered a fairly disciplined approach in terms of changing equity allocation, looking at the valuation and momentum of the market. We hope to continue same discipline going forward, and it's a great product for all those investors who want to pass the burden of asset allocation to fund house or to the fund manager rather than do it on their own. Kotak Balance Advantage Fund over a cycle of market should be able to reduce volatility compared to an equity fund and should be able to deliver return which is comparable to the benchmark. This is a fund which tries to reduce volatility and yet tries to outperform the benchmark index. This fund is appropriate even for lump sum investment, as the fund manager itself is doing an asset allocation between equity and debt, looking at the valuation of the market. In a simple word, if I have to describe Balance Advantage Fund category, it's a Harfan-Maula fund. It's automatically balancing allocation between equity and debt, looking at the valuation of the market, which helps them contain volatility, and thus investors can look to invest even on a lump sum basis in this kind of fund. Thank you for your support during this tough period. I'm sure investors are worried with all the volatility in the market, but the past experience does suggest that if you bear the volatility, eventually good days come back, eventually returns return. Thank you for your support. We hope and pray medical science finds a solution for coronavirus as quickly as possible. And as soon as that development occurs, markets will start bottoming out. And from there, the volatility will come down significantly and the return prospects will improve significantly.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.